Hello and welcome to Budget Insider, Business Insider, India special feature ahead of the Union Budget 2023-24. Joining me today is Samir Arora of Helios Capital. Hello and welcome, Samir.
Yes, Helen.
You've been talking about budget being a non-event and that, earlier you used to buy stocks which were, before the rail budget and this is the orders and this is the likelihood, etc. You say you don't do it anymore. What is the reason for that?
Well, before that, I used to, from Singapore, fly to India, sit in a group with our office guys, have the trader sitting right opposite, all that. All those days are over because in those days, the policy decisions were every time there would be somebody favored, somebody hurt in terms of either industry or company, or we would analyze them wrongly. Or in our innocence, we would do things like, oh, they have an increased allocation to infra, so let us buy an infra stock, or they have increased allocation to some in railway budget to some security for, railway security or something. And then we tried, or signaling companies, some nonsense we used to do in the beginning of our life. Last year, I completely missed the budget. I was flying from New York to Singapore in the air. And I asked my office guys that I forgot about the budget, in the sense that my assistant, as I said, they're charging me some $700 for change of fare plus change fee. And is it worth it? And they all said no. So I didn't change it.
So is budget a non-event now?
This was last year. But now that I'm here, of course, I'll see it. But in general, this is a good thing. It's a good thing that we are not expecting every time that somebody will be chosen as a beneficiary and somebody will be chosen as being hurt. So we now look at it for big picture, and also because we are doing India, so we should know what all is happening. But it's not that there is any attempt to do action that day. In the end, we might still do one trade here or there. But broadly, the last time it made a big difference, and I reacted very fast, was in 2018 when they introduced long-term capital gain. So on that day, I shorted nearly 20% of my fund in the index, because that fast you can't do any stock. So that helped me in 18 a little bit in those days, in the, that Feb month or whatever. But in general, we don't think anything like that will happen. So
markets are always skittish before the budget. The 1 month before budget announcement, markets typically don't do well and they're in the negative, etc. Why is it that market still continues to react to the budget, before and on the day itself? On the day, I can understand, but a month before the budget, I think people start looking at figure.
Historically, I think it was the other way around, that the market would be up in November, December, Jan. Because you would be excited about budget, then you would be disappointed, and then you would say, oh, March, for some reason, liquidity, tightness, or some words we use. And so it would be negative afterwards. I think for the last few years, this thing always about capital gain being tinkered with comes in. And then when it doesn't come in, we all celebrate and say it's a good budget because nobody touched our capital gains, other than one time when they did touch it. But right now, this time, I am disappointed with our market, because I never thought that when China is doing well and US is doing well, and that we are going to be falling though so much, or that foreigners will redeem from India to buy China. I mean, that is a height of idiocy, but we have to deal with them also for some time, even though I'm also an FPI or FII.
I know. So are you expecting any sort of rationalization of taxes or any of that ahead of the budget, which would be in interest of FPIs as well as domestic investors?
No, I don't think that capital gains tax can be, the period they increase, that will be another big negative. Of course, the budget may already have been made, so we can't say looking at this, they won't do it. They would have already done whatever they have to do. But only thing which can be positive for the market is if they increase that exemption limit or whatever, that, before you get taxed, or increase that so that the slightly larger middle class gets out of the tax bracket. They may still have to file it, but they don't have to pay till they cross some 3.5, 4 lakhs or whatever. So that will be a little bit of a help. Beyond that, if they talk about investing in infra or investing in road, we will all clap and not do anything about it.
I know, I've heard you say that before. Other than that, do you think there's anything to revive growth or, give a push to capital expenditure? Do you think any of those measures that you think
those measures can only be related to government spending, because otherwise tax benefit, they've already reduced corporate tax for new companies to 15%. In fact, they have to extend that, I think, because that might be ending in a year, right? They started that in 19 and it was for 5 years. So for a company starting now, which has to do commercial production in 1 year, maybe they need more visibility if they want to extend it. So that could be viewed as a positive if they say that that 5 year period is being extended by another 3-5 years. Other than that, what can they exactly do specifically for somebody? There's no other way of doing it anymore.
Right. True. Does the fiscal situation bother you? Because that's something that, some of the market specialists and, market experts like you on Twitter seem to be airing the concern on the fisc, on the twin deficits, etc. How do you is it a cause of concern?
So right now, we don't overly focus on it in the sense that after COVID, everybody in the world was allowed to have a higher deficit, every government. And in that sense, the Indian government's increase might have been one of the lowest, because they went from some 3 point something to now, I think 6, 7 or whatever it is. So in US and all, I think it tripled because of the vast amount of money given out. So therefore, I think right now the market, at least the equity markets, don't focus on it because it is viewed that it was because of this event. And therefore, as you again show a glide path, that you're coming down some 20 basis point or some X% per year, then I don't think anybody will care right now.
That's
in the new environment where everybody has done it, and there is a reasonable excuse for why this has gone up because of COVID and all that. So therefore, the focus on it for the moment, I don't think is there, because I think it's fair also. It was a valid thing for which you had to increase. And now slowly you have to show that you're coming back, and which you will over time, yes.
Right. Coming to your specific areas of interest in the market, you've talked about exiting completely the IT services space. What was the reason for that, and what did you replace it with? Or is
First of all, exiting means what? In 3 months, I might be back. I was saying from July onwards that broadly, because I did a very little in Jan, less than 20%. Those were those very high P at that time, L&T Tech and LTIS and all, which were like at that time some 45, 50 P, if I remember broadly. But the rest I did more in a sense because it looked to me, although it has not worked in this calendar year, but it worked last year, that India is doing better than the world. That the world is seeing problems where now it has become even more clear that all these guys are firing, the tech guys are firing, Google, Microsoft, even business software companies like Salesforce, the cloud companies like CrowdStrike, the security company like CrowdStrike, and the other one, whatever, Snowflake, whatever, all those companies. And therefore, we can't keep saying that, no, our clients are not affected, but everybody else is affected. In addition, it was Europe. So now till December, it worked. Not a great thing. From July, maybe it underperformed by 9-10%. But this month is already up 5% relative to my index. So it has not helped. But my big picture still is that it is unlikely to irritate the hell out of me if I don't have it. So I don't care if it does well as much as what else I do with it. But it should not be that, oh God, it outperformed by 15%. What a big goof up in changing the sectors. So as of now, that is the view, that we'll wait for 2-3 months or more and then see how it goes. But right now, it doesn't look to me that there's any logic for it to outperform a lot. It may form a line also possible, who knows. So the story that the other side gives is that it's a long-term, it has come to long-term average valuations over the market. So I always ask them, but when does it trade below average valuation? This seems to be the environment, according to me, where in theory, India is doing better and the world is doing worse. And secondly, that the world is being slowed down by higher interest rates, which have not yet worked. And therefore, the interest rates are supposed to be higher for longer to make sure that that happens. So looking at the current, we agree the US Federal Reserve is surprised that even yesterday's GDP was 2.9 and not 2.8. So if on Feb 1, the Federal Reserve says I'm going to increase rates because 2.9 is too high, They, I believe, have projected, I think, 0.5 or something after all these rates. But it's not happening. But they want to make it happen. They want to bring down, I guess. Otherwise, how will you control inflation if the number of jobs openings are much more than the number of unemployed people? There's that. But I don't think it's going to pain the hell out of me. This month, actually, it has been a bit bugging, I must say.
And what did you replace it with? That's on the
Also, that over time, as in the last 5-6 months, we have basically 3 sectors we invest in, which is financials, consumer, and IT. So broadly, it has gone into the mix of the other two. It's not that we are sitting on cash. So if those also perform plus minus in line, it doesn't matter to me. I would have vented this thing. I think it is negative. If it doesn't bug me, I can live with it. As long as it doesn't bug me, then I'll see. But in April, we'll see. Right now, we are not bothered for 3 months. I'm hoping that the budget will give some fillip to my consumer stocks. Who knows? Let's see.
That should ideally be the focus of the budget, is to revive consumer sentiment, especially.
And also, I can give another angle to it, which is that we are going into election. Election means a lot of money spending by all the parties. That goes to genuinely to the bottom consumer in the sense of hiring cars and rallies and people and posters and boards and travel and whatever the money is spent on. So that money, which is a few $1 billion extra, directly going to somebody who can buy small ticket consumer items.
Agreed. Makes sense. Coming to this is my favorite question. Last few months, years, but this, towards the end of this last year, July onwards, I think a lot of stocks which typically have languished for a long time have done exceptionally well, which includes the PSU bank space and some of the others so-called value picks.
NTPC, Coal India.
Yeah.
The guys who bought those stocks did very well last year. But if I look at 3, 5 years, 10 years, 15 years, we have beaten the hell out of these guys, including the biggest mutual fund of India. So therefore, we have to say, no, we agree. We believe in our own thing, which is that we are not overly doing the value thing. But unlike others, our model is not that we are value guys or growth guys. We can buy a stock saying it is very cheap and another stock saying it is growing very fast. So, for example, from 2020 to now, one of our top holdings is State Bank of India. But we haven't bought any other. And we won't buy an NTPC unless somebody puts a gun on our head or things like that, which have never worked for me just because people are fascinated. I don't do. So, but we are not totally all out or all in kind of guys. There's a group which says I only buy growth and some other guy which says value. We are not like that. We will buy all kinds, except that some kinds we have never bought. So it's very difficult for us to suddenly start liking Coal India or something. Or even.
Correct. But overall, I understand that you don't do it, but I'm asking for this 30,000 feet view that there is this huge debate around value and growth has now been beaten down, especially what has happened.
Even we agree. So we are also buying, we are saying, please get us 10, 15p stocks, which will be easier to accept. But we just don't want them from these two group kind of thing. So generally, the sensitivity for now has gone up because it's very natural that interest rates being higher makes companies which have a sort of a high valuation, which means delayed this thing, and you're buying them for longer term growth. In theory, even though you may not be literally doing it like that, has to fall. Plus, some of the very expensive stocks we are short. The most expensive stocks, 7, 8, all of them we are short, whose names I will not give you, but broadly you know which ones. So it is this in between where on the margin we also say, I can buy something, a little bit more reasonable and not just rely on growth. But even then, we even bought Paytm last week or last month because we are in that sense, other than not liking 1 or 2 PSU type gang because of 25 years of never having made 1 rupee from them. Broadly, we are willing to buy everything else which other people call value.
You talked about Paytm. That's my next question. You bought Zomato and Paytm, and after the stocks were hammered quite badly. But what about the business case? And I'll just finish this question. The business case is likely to be challenged for some of these players. And Nika, I remember you explained that many others can do it, and that's the view generally in the market. But Zomato and Paytm as well are likely to face similar competition from various other players as well, whether it is.
No. Zomato, actually, I need to do a training course for both these guys. Not that they even meet. But the thing is, Zomato and Swiggy must be the biggest idiots in the world if they now compete with each other. They all have broadly 50% each. Both have 50% each. There is no third fellow in this business. Why are you fighting with each other? You cannot drive the other guy out. One guy was valued at 10 billion and raised so much money, and this guy has 1.2 billion or 1 billion cash. Zomato. They have to not fight with each other. If they are fighting with each other, they are idiots. But I don't think they're really fighting. It's like saying that if an asset management company today says that I'm starting a new fund, which is say an ETF fund and which will have 5 basis points management fee, will any analyst say, oh, 5% management fee? If this was applicable to the whole company, then the earnings will fall so much. Now, Zomato said, I'm trying 160 rupee thing just to see how many people respond. What is their stickiness? What is the point of applying that to the whole company and saying, oh, therefore this means that this has happened, that has happened? Hundreds of things will be tried by companies. But look, big picture. There are two guys, both are big enough to not be driven out. There's no third guy. Just grow at a normal rate and move on in life. But in general, because they have 1.2 billion cash and because they're broadly breaking even, other than this Blinkit thing, where also the losses are a bit controlled, we think it's okay. So I don't think it's going. And Paytm, who's competing with Paytm, 3-4 similar guys, Phone Pay and others. Please remember one thing. In 99, I used to own Z. Okay. And Z was up some 100 times in that period. But during that time, one fellow from Sony, the CEO of Sony, Mr. Kunal Das Gupta, met me, and he was saying things about Z, I said, every day pray that Z does well, because you are unlisted, he is listed. If he does not do well, you are not getting your IPO. So if all these other guys think that if Paytm does not do well, they can ever have an exit, they can dream for the rest of their life, unless they make it zero, which they can't. Right? Then they can say, see, we made them zero, now we are the new. But broadly, that guy is going to be there. And you are going to be benchmarked off him. That is the reality of life, that a listed guy will set the benchmark for the unlisted guy. Therefore, nobody's going away. And the brand of Paytm is bigger than any brand that somebody has created in front of us. It also has $1 billion in cash. They are broadly in Davos. That fellow Vijay Shekhar said in an interview to one of these business channels that we will, other than ESOP break even earlier than guided, their guidance is for September quarter. So my bet is they'll break even in March, because if they're going to break even in June, what a big deal that you you met your target some 2-3 months before, at least meet 6 months before if you are going around the world and spending whatever money it takes in Davos to even go there. If all you're doing is 3 months, this thing. So let's see. But broadly, our game is that we are buying 20-25 stocks of 2% each to get 50% of our portfolio. Literally every multi-bagger of our country we have had, other than some specialty chemical, there also we had SRF, but broadly not others. But every other, because we had bought 2% and that became, but we didn't know out of these 25, which one will become, but some of them become. Because we have done our work, but exactly you don't know whose turn it is next. So 10 of them will do well out of 20. Some will break even relative to market, and 1 or 2 will lose you 20%. And so it doesn't matter.
What about corporate governance in these companies? Do corporate governance standards match up disclosures? Because they have a very different.
So we bought Zomato after they said, I think it was the June quarter or the September quarter, when their stock went limit up, that we will now do meetings, that we will not invest in unlisted companies, that we will limit our investment in Blinkit. And in theory, guys like Sanjeev Bhikchandani, who you can say are the best in corporate governance, and private equity, the only issue with private equity is that they themselves are sellers in these things. Otherwise, they are normally good corporate governance guys, because they have to add that much value to a company and make it go public. So broadly, it's okay, other than you may say that this the fact that they themselves have to sell, but that's not corporate governance. That's a different negative. It's a negative, but it's not corporate governance. And beyond a point, who knows what is corporate governance?
Good one. What about what's going on in the market after the Hindenburg report on Adani Group? What's your take on that?
My take is that, broadly speaking, the FPO will still go through. And therefore, after 2-3 days, this issue will get off the headlines. And then over time, the Adani Group has to answer those questions. Right now, the biggest thing is for them to have the FPO go through. Because once the FPO goes through, then they have 20,000 crores. And therefore, the banks and others, first of all, I don't think any bank is in any pressure because of this. And it's crazy that they're selling HDFC Bank and HDFC Bank and State Bank, all the ones which I own. For what reason? Nothing is happening in 1 year, 2 years, 3 years. So from Adani point of view, they have to answer the question. But before that, they have to get the FPO through.
But is there a cause for concern? Because volatility index has shot up today, markets in a complete.
So my bet is that today is the bottom. In fact, that's why I tweeted with people didn't understand that pyar kiya to darna kya, because I added 4-5% to my longs.
Adani stock.
No, different stocks. Could be Adani also, who knows? But not, because we own Adani Port. Okay,
Right.
so we added a little bit there. Wherever we just broadly added to a few names which were down, not today, but overall this month down 10-15%. We are not buying anything which is not down, because what is the use to add something which is up or flat? But we didn't do a lot also, because we never do anything a lot, because tonight I have to see movies and Netflix. So I don't want to worry in the night. Oh my God, did I overdo in the day by getting carried away? So every night I can sleep peacefully, whatever may happen to my longs, to my shorts, and that is how we do.
You tweeted a photograph of yourself with Warren Buffett, was it? No.
I haven't got one with Warren Buffett. I wish I had.
What's your strategy when you compare? You talk a lot about Warren Buffett. You also talked about analyzing the portfolio performance over 10 years. How do you see his strategy to be different? And, you also talked about his long tail outperforming. The big. So can you compare and explain, because lots of people in the market love the Buffett Gyan and how he does it and how he's consistent.
So the point,
the difference between your strategy and his, and what works.
So my point is that Warren Buffett, maybe many years ago, had a series of his top positions, which were 20-30% at that time, do well. But that is as much luck as analysis, or maybe it was analysis, but it is not easily replicable even for the same person. So the presentation which I made and what our series called Dhan Ki Baat, okay, saying look at his portfolio on 2000 December. Then 2012 December, we just took a 10-year, 5-year, and if you see top holdings and you broadly see their performance of those stocks. Now, some he has sold in between, but we know that broadly none of them have gone up a lot while he sold them. Okay, it's the same thing with everybody. You sell what doesn't work. You keep what works, because while going in, we are very positive about that stock. So if it does well, you say exactly. But if it doesn't do well, then you get upset why it's not done well. So broadly, the profit taking is not a very big this thing. And actually, Buffett says I will not broadly take. So if you look at that, his strike rate is very poor. This is black and white data. It is not that I am just saying it. Out of 20 stocks, some 18 will not outperform the index also, but he outperforms. And those 18 stocks underperform Berkshire's own performance. And this is not one period. I've done from 2000 to 2012, which is 10 years, then 2017, and that is, I think 16 also, because Apple was bought for the first time in 16. Then I've done 3 years. In all of them, the strike rate is not high, which means what? That means the tail is working better, or the unlisted is working, or whatever, but not the visible names. We have had the similar thing by saying that we know the difference between good and bad. So we are buying 20 stocks saying these are all good stocks, but who knows which stock will do well? And mostly a large number do well. For example, last year we had Varun Beverages going up more than 100%. Now, how would you imagine? By the way, my offshore fund that we had from 18, so it's already up 4.5 times for us. But do you think in 18 we knew, or even in 21 we knew that this fellow will have a drink called Sting, which is the poor man's Red Bull? Pepsi has that means. And that will become such a, who will know? You think management knew? You think Pepsi knew? Actually, Coke also didn't know. That is why Coke, after seeing it, quickly ran around and started their own drink called Charged. But that means that Coke did not think in 21, otherwise they would have done it at the same time. So what I mean is, you are broadly differentiating between good and bad and hoping that a slightly larger number than the general universe, you'll have more hits, or you'll have slightly less number of bad this thing. So in that context, we have all these stocks, and mostly it has worked. That is why we are wearing a suit on a Friday afternoon.
Good. Tell me, what is the typical number of stocks that people should own in a portfolio, whether it's a fund or an individual, typically including...
We are a fund, so somebody could own a little less, but they should not own 5 and 7 stocks. We own 35 broadly as a thumb rule, which is 10 larger names of 5% each, and 20 to 25 2% type names. And the 2% names give the massive alpha, and the 10 are supposed to give consistent little bit, 2-3% outperformance, like this HDFC Bank kind of guys now, or say TCS or Bharti or somebody which is not going to blow the lights out. But you need that also, because otherwise it becomes... And in the second group, we are not necessarily buying only new companies. It could be old company that has fallen a lot. Like suppose you buy after COVID some Indian hotels, or we bought IndusInd after it had fallen 65-70%. So we are not going to buy 5%. We'll buy 2.5%. And if it does well, you can add, which we do add, to make it 3-4%. But first day we might even buy 1.5%. Sometimes the stock is illiquid. Sometimes you buy it and then it goes up a lot and you leave it. Chalo, theek hai, jitna mil gaya, you make something out of it. So you can't say I buy 5 or nothing, because half the stocks you buy, you will not get to 5. Then what do you do?
Correct.
So that is the way.
On Twitter, you have an enormous fan base, and you have fairly interesting conversations on Twitter as well. Your fans are looking forward to your fund being launched, your mutual fund being launched in India.
Even I'm looking forward, yes.
So can you tell us a little bit about how different, because it's already a crowded market with 40 plus funds. So what are you...
It's not crowded. In fact, that is the beauty. Of course, we are still some time away. These approval processes are long, so it might be still 5-6 months away. But the beauty is there is no crowd. There are 10 guys who are very big. And then there are 10 guys who have become big in the last 5, 7, 10 years. The rest 22 have to be replaced in 1 year. So you have to go to 20th in not 1 year, but maximum 2 years. Then the fight starts. But the thing is that when I was in Alliance, we did not have a local partner. And we were competing with these guys who had local big names like HDFC, ICICI, whatever. And they had big partners like Standard Life, Prudential. And I came Bombay for the first time in my life and stayed in a hotel for 2 years. And we were number 1 in 8 years. We beat all the similar foreign brand, but a big local presence. But now those guys are very big, so you can't become. I mean, they have become very big, like, the HDFC, ICI. So it's okay, those 10 guys are big. And then the 10 are also quite big, but those 10 will take maybe a few 5-7 years. But the 20th to 42, you see, they have no reason to exist in equity, because they neither have a brand, they neither have great performance, they neither have a known fund manager. They have mostly some captive distribution or something. Okay, that they can enjoy, but so we think it's very easy to be in the top 25, which is not a bad starting point in say 2-3 years, 3 years, 2 years, whatever, something like that. And we are energetic. So let's see.
But, in India, one of the things that we see is that every year you have these rankings, and each year there is a new guy who's topped it, and then the other guys have fallen, and typically you are looking at consistency, etc. But then it becomes confusing, because 1 year one fund does well, the next year another one becomes number 1.
Correct. Okay. So
also, generating alpha is a problem for when it comes to large cap stocks, and I'll take a second here to quote you. at one of these investor summits, you had mentioned that, when it comes to large cap stocks like, Google, Alphabet, or in India, TCS or Reliance, kya hai isme naya research kar loge that, that you'll find out something new and pick something
Correct.
which is going to give you alpha. How do you, is that a problem, and how will you kind of address
So
that?
first of all, we are not talking about older stuff. We are talking about the Helios days. So in the Helios days, which is the current days, we already have 18-year performance. And in that, there's only one fund in India which has beaten us in 18 years and 10 years, whose name we tell privately, but why should we publicize him? But the bottom line is that our fund is with a 60 net. So with 60 net, we compare with all the long only guys, and there's only one long only guy who's beaten us. And I was telling somebody, and they said they have done quite badly in the last 1 or 2 years, which I did not know, because I was just seeing 10 year and 17 and a half years. But anyway, that we'll have to do. Our model has worked more or less, not every year, but it has a much higher frequency. Like on our site, you can see the frequency or the consistency with which we get shortlisted for the best India fund. We don't win every time, but no other fund has been nominated more times and no other fund has won it more times. But you don't win every time. But you're broadly up there in the group which is shortlisted, because our strategy is not to be either value or growth or quality or mid cap. We want to do all gitch pitch in one. And therefore, the top guy may move out, but we are somewhere there. So after 2-3 years, when the churn happens, like for example, if somebody is a value guy and somebody is a complete growth guy, even before going in, you know that only one of these guys will do well.
True.
Now it's the investor and this distributor which is worrying that whether I should buy this guy's fund who's saying I only buy value, or that guy's fund which only says growth. I say, bhaiya, hum hai jo dono khareedte hain. So neither will you be embarrassed if you're completely wrong as a client or as a distributor. And black and white, you can see the pure value guy and compare with us, or the pure growth guy and compare with us over a cycle, which is say 5 years. And we broadly have, beaten them. That's as I said.
So you think that it's possible to create alpha even when you're looking at a large cap fund?
No. So we are not planning initially to do a pure large cap fund. We want to do a flexi cap fund. And then some other fund, but not a pure large cap. Yeah, that is too much, because the rules are also very strict in terms of 100 and from that. No. So we are not going to do, at least for the first 2-3 years, we are not going to do. We need, but we still even now invest in large caps. But broadly, because we need the stability. But because we one of our parameters is valuation. All the well-known large caps we have rejected, and many of them we are short.
Awesome. You clearly will not name them.
But everybody knows them.
True. My last question is on what is expected for the markets 2023. I know what you've said in the past, so say something.
So my problem is that I have gone horribly wrong so far, although it's only 27 days. But I think India will have a good year, because I'm a simple guy, is that if the US is doing well and China is doing well, you may underperform. But why are you falling? And secondly, why are these idiots selling from India to buy China? You put new money into China or you do, but I can't imagine that they want to put full weight into China. Actually, there was an article in FT 2-3 days ago that these big funds are looking at Europe now, because they just don't know what to do with the big weight that they had in China. So they may keep the old stuff. I think the fact that somebody is selling India to buy China, by definition, it looks to me somebody in a sense small, some hedge fund type guy who has limited capital, who's moving from here to there to maximize, which he will not be able to maximize because China already have 45-50%. But I can't imagine a new endowment, a new pension fund, some sovereign fund to say today that I want to go beyond my weight in China. I think they won't even reach the 29% or whatever is the weight. So therefore, this fact that you're selling from India is a bit of a surprise. But if it is just a trade of reopening and all that, then plus minus 1 week to 1 month, whatever it'll, because the default action for foreigners is to buy. In the last 20 odd years, there have been only 4 negative years. And because they keep getting money and they have to put it in the world, and our relative position has gone up. better, has become improved relative to China also, because everybody wants to now diversify both from a supply chain angle, both from investing angle. It definitely has become a little better than Europe. And generally, we are doing well. We were doing well. We are doing well. Only today, we are not doing well for some reason in the market.
Is valuation a concern? That seems to be the only argument that
No,
Indian
I don't agree with valuation as the reason, because the valuation is an issue if two markets are going up and then after 1 month or 1 year you say, oh, that market outperformed and suddenly it is now at a 30% premium, so it has to mean revert. But let us say if there are two companies or two countries and there is a specific issue in one, there is a specific where you were hurt by policies, by COVID, or by fraud. After 1 day, you will say, no, there's a premium. First of all, Indian market didn't go up for a year. So our valuation has not gone up. What has come down is the Chinese valuation. And do you think that the Chinese valuation came down without any reason? There was a specific 10 reasons for it. You heard the EdTechs, you heard Alibaba, you heard Jack Ma, you heard Didi, you heard the gaming companies by not letting them release new games. You did COVID, the zero COVID. अब उसके लिए वो गिर गया तो हमारी क्या गलती है इसमें?
True.
And even if it is, वो little bit mean reversion करने दो ना. But I'm saying we should not be falling. We may underperform. Possible, because if you've fallen a lot, you will rebound first.
True. So there's not much, no big risks to Indian equities in that.
Right now, I don't think there's a risk, because generally new things have to happen.
New things are.
And by the way, who are these guys, as I said, who are selling India for some corporate governance and by China? I mean, कौन है गधे?
True, but as we discussed about corporate governance, least said the better.
Yeah.
So there's no big risk that you see, right?
I don't think so.
Oh.
That is the advantage of a long short fund. Hoga, so we will act on it. But right now, we are reversing the long short to a more long.
More long, right? Super. We are running out of time, and thank you so much for joining.
Thank you very much.
Talking to Business Insider, Samir. As always, a pleasure having you.
Thank you very much.